to Nick Goodall from Cotality. I'm Bernard Hickey. This is a mini hoon on the Kaka. Nick, lovely to have you on the show again, talking about the things we love talking about, interest rates and house prices. Big day. The Reserve Bank has this afternoon cut the official cash rate by 50 basis points to 2.5%. What did you think, firstly, of the decision?
Yeah, kia ora, Bernard. Well, firstly, thanks for having me on. And yeah, certainly an interesting one. I think, there was no debate. There was going to be a cut today. It was just the size of that cut. Interesting that it was unanimous. So all members voted for the 50 basis point cut. I was a tad surprised. I was expecting the 25 basis point cut myself. I can absolutely understand the reasoning for the 50 basis points. And the main reason, because they debated it themselves, it seems to be that they really wanted to send a bit of a shock, really, and say, get out there and be spending to people. We've sort of been talking recently about, it wasn't only a few years ago we've been told to cool our jets by the Reserve Governor. We're suddenly been told to speed them up and really get them cranking at the moment. So I think that's the big line from Reserve Bank here. Front load some of these cuts and get it out there so that people feel better and start spending.
Yeah, I mean, we've gone down from 5.5% now to 2.5% in a relatively short time. We've had much slower cutting cycles before. If you said to people in August last year, by October of next year, we'll have an official cash rate at 2.5%. How do you feel about it? What do you think will happen? I think most people have thought, oh, that'll get it going. So what's going on here? Well, let's talk a bit about the housing market to start with. Those rate cuts. How have they been received by the housing market?
Yeah, I mean, that's probably one of the most interesting points, right, is that we haven't really seen any ignition in the housing market despite those falls. We know that monetary policy does have a lag effect, so it does take some time to work its way through the system, particularly when it comes to people fixing their mortgage rates. So, yes, many people have fixed onto lower rates than what they were a couple of years ago, but we've still got upwards of 60% of people to roll on to new mortgage rates over the next year. And those people will be seeing significant declines in their mortgage payments if they choose to reduce their payments. And I suppose part of the idea is that will be then passed through, and people will start to go out for dinners and go on domestic holidays and buy those big ticket items, and that will start to get the economy going. It just hasn't really occurred, and I think partly there is this extra nervousness for people, particularly from the job market. So yes, you might save some money on your mortgage payments, but that money goes somewhere else because high cost of living at the moment. Plus, you might have overhang over your head. I'm not sure my job security for the next wee while, and so people therefore haven't got that confidence to go out there and spend that extra money. And so I think that's why we haven't seen the reaction in the economy. And looking back to GDP of Q2, of course, a 0.9% contraction was a bit of a shock to the system, and that's certainly what the Reserve Bank's looking at here and saying we need to get this economy going, and this is the main lever they've got to do so.
Yeah. I wonder if people are repaying their mortgages using the same rate they were on before, but with a lower interest rate, they're effectively repaying it faster. And I'm always a bit surprised when I see the stats on the percentage of home loans that are actually ahead on their payments. What do you know from what you're seeing with the data in terms of amount of repayments, paying early, keeping the same repayment level?
Yeah, of course, as you say, that's a financially prudent thing to do. If you adjust them to a lower interest rate, but you can keep affording the same payment, then do so. Any mortgage advisor would tell you to do so. And from all our conversations with mortgage advisors out there, they sort of say around about half of all people they've been dealing with will be keeping those payments the same size. And as you said, then they're ahead on payments, which can protect them for the future if there is something that comes up ahead and means they can't make a payment, then they've got ahead of the game, so that can sort of support them in the future as well. So yeah, I do think that'll be a part of the story as well, on top of the fact that, as I say, there's other costs that are working on people and just that nervousness around jobs and how tough our unemployment is at the moment. It's not exactly a great situation, and the Reserve Bank's doing everything they can to help.
We're in an unusual position at the moment. Over the history of the housing market, we haven't had a period where nominal house prices have fallen as far as they have since the end of 2021 and pretty much stayed under those peak levels. I know it was quite a burst up in 2021. You could argue unnaturally bursty. But, a lot of people have never been here before. They've never had to think, well, I'm okay with selling the house for less than what I was told it was worth a year or two ago. In some places still down 30% or so. I wonder if there's a type of Mexican standoff going on in the market where people who aren't being forced to sell, they might be a hit on their mortgage, they may have a small mortgage relative to the size of the house, but it's important what they get for it when they eventually sell it, because often it's the main part of their own financial plan, to retire or to start a business or close a business or move into a retirement home and that sort of thing. I wonder if there's a sort of a stasis, a standoff going on, and even when interest rates are cut, it's hard to get things moving when people say, "Well, I'm not going to sell it for less than it's worth."
Yeah, I think that's definitely happening out there. There is that standoff. That still the buyers got the power. There's lots of property still available for sale. It has declined compared to last year, but it's still well above sort of 5-year average. So I think there's lots of choice, which means those buyers don't have to pay any price, and they can be comfortable that if they don't buy this one, there's another one just down the road that's either for sale or might come up for sale at some stage in the future. So they're not desperate. But I think you're right in terms of the vendor side of things too, who are also going, well, I know what it used to be worth, and I've got this figure in my head, or I saw my neighbour sell their property a couple of years ago for X amount, and I want that same amount. And they haven't got that desperation to have to sell it either. So they just hold off, and they just hope that the market's going to change at some stage, and there'll be some competitive buyers, and they'll be able to get that price eventually in the future. But it's really interesting because we have actually seen sales transactions happening. The increase in sales transactions has been consistent since that sort of drop of the market back in 2023, and we sort of saw very few sales transactions. There are sales ticking over, but it's very much that those buyers have got the power and they're not willing to overpay. Again, they're probably sitting there going, I've heard the stories of those people that bought at the peak. I'm not going to fully max out my mortgage, even though with lower interest rates I can borrow more compared to my income. And maybe that's also one thing to consider for the future, is just the role that the debt to income ratios are going to have, because as interest rates continue to fall, technically you can borrow more, you can pay more, but you're going to have that DTI cap now for both owner occupiers at 6 times their income and for investors at 7 times their income. So that's certainly one thing to watch for the future too.
Because in the past, often when there's been a cut in interest rates, some of the biggest buyers, if you like, the biggest impetus into the market has been of rental property investors, both the multi-property investors, someone with 2 or 3 or maybe even more, and particularly sort of mums and dads. What are you seeing in terms of the share of the buyers at the moment who are mum and dad rental property investors, movers, so people who've already got plenty of equity in their home, or first home buyers?
Yeah, it's been a really interesting one. First home buyers have had a really strong share of the market for the last few years now, and continue to sort of hold that position. And I guess the factors, convincing first home buyers to get in are still there. It's an expensive rental market. You're buying long term. You can use your KiwiSaver, low interest rates. So those first home buyers, those motivators haven't changed. They're still continuing on. What we have seen though is those investors have started to come back into the market, and it is particularly those smaller mum and dad type investors that might have one rental property already and they're buying a second, or maybe it is their first rental property because they've got lots of equity in their personal home as well. They're sort of coming back into the market. So I think there is still that desire for housing as an investment. People still have heard all the good stories of the past as well, decades and decades of property investment. And again, if you're holding long term, they're hoping that that payoff is still there, as long as you can make those sums work when it comes to getting that yield. It hasn't really stormed away though. And I think things are better now because there's less regulation. In terms of bright line tests being shortened, you can write off your interest costs again. So things are better than they were a year or two ago, and interest rates have fallen, so that's helping too. But they're not sort of getting everything their own way because it is still relatively expensive. That yield is still quite low, and if you can't make it pay, in terms of your yield to cover your costs, then it's still pretty tough to justify the decision, especially with reduced capital growth expectations now. I mean, certainly here at Kotauti, we sort of expect about a 3 to 4% average annual growth rate for the next few years. Nothing like the sort of 6 to 7% that we've seen over the previous couple of decades per annum. So I think with that reduced expectation too, that's holding some investors back.
It's because it's been 2 or 3 years now where prices have either fallen or been stable. They might have risen for a month or two here or there, but nothing special. Can our economy work or grow when house prices aren't rising?
Well, you'd really hope so. I know that there is obviously a strong connection there that yes, all those people that have mortgages They feel the wealth effect. If interest rates go down, they feel like they've got more money, and so they'll go and spend. And especially if equity is growing, then they feel more wealthy, and so they'll go out there and spend too. But we have to have an economy that operates without this. I know small businesses might sometimes draw on their home to get the money required to invest in their own businesses. But it's not the whole economy is dependent on it. I think we can get some growth going, but we probably need a bit of fiscal support from the government to assist the monetary support that's coming from the Reserve Bank right now to really get that going and provide that confidence and certainty to the labour market, really.
Yes. So far, the government has said it's keeping a hard line on that fiscal policy. It believes that restraining government spending will help reduce interest rates, and that will get the economy going again. Remains to be seen, as they say. Nick Goodall, who is from Cotality, previously known as Core Logic, after today's Reserve Bank rate cut. Nick, thank you very much for being on a mini hoon on the Kaka.